Good morning from Chicago, traders. It is 8:02 a.m. on Central Time on Thursday, the 23rd of the eve of Christmas Eve, 23rd of December 2021. Here we are near the end of the year. Thanks for joining me today in what is the start of a holiday here, a holiday weekend. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. This is episode number 2137. I have been off since last Thursday when a newborn baby was induced and has arrived into my family. A wonderful blessing. Beautiful girl named Araya, Raya. She's been a pleasure so far. I figured it's going to be exhausting, especially at my age, but she has been fantastic. So we're back in business today. It wasn't planned this way, by the way. The baby was supposed to come a lot sooner, so I would be back in the full swing of things by now. So I didn't expect to come back the Thursday before a holiday tomorrow where the markets are completely closed. Only to go back into a holiday, but a schedule is a schedule, and here we are. So anyway, episode number 2137. Let's take a look at the overall market picture using the Convergent Trading pre-market summary sheet. I'm sure you've missed this. The market posture so far is mixed to mildly up. Mildly risk on. That is the overall market posture coming into today. The biggest news is really, the biggest news has to do with the Omicron numbers, which are actually rising. There's some big infection rates going on, but South Africa, where this variant has come from, South Africa is seeing numbers dropping rapidly also. So it has a very sharp skew in that it like a very high kurtosis, infection kurtosis, in that it spikes up very quickly, but it also falls off very quickly. So the infection rate's very high. The hospitalization rate is not as high. There's been one death reported as a result of this variant in the United States so far, and the infection rate is very, very high. New York reported, I believe, 28,000 in a day or something like that. 28,000 in a day. So the market is discounting, despite the fact that Europe is shutting down. The market is mainly discounting the threat of this variant. Of course, this doesn't end the entire story of the pandemic, but here we are. The other piece of news is, of course, holiday trading. Expect the markets to continue. I was reviewing the charts, just trying to catch up from a week ago, just bar by bar, and I'm seeing that the order flow is super thin, and that's just going to continue. There's very likely to be it's very likely to be a relatively thin, fast market. So pay attention to the rotation numbers right here on your screen. The rotations have dramatically increased. If you recall from a few weeks ago, it dropped down to about 5.5 points in the S&Ps. In terms of the widest harmonic rotation. Now it's 9.75 points. What does that mean to you? It means that your stop has to increase or risk getting triggered a lot more often in this kind of environment. So technically speaking, a stop needs to be outside of the value area of rotations, and that's the edge of the value area of rotation. So this is basically saying, as of the last 20 days, where we are now, it's saying that you need about a 10-point stop in the S&P. That's how volatile this is. It doesn't mean you should trade that way, and I'd hardly encourage you to trade micros instead of the minis. You can trade more contracts that way. to manage risk, to mitigate risk, to scale out, and risk less per contract in terms of dollar value. So even though it's slightly more expensive in terms of exchange fees, but hey, that's why EdgeClear exists, to reduce your costs. But that's a nice little plug there, product placement as they call it. But it's a better way to stay in the game. So with high rotations, high volatility, comes a significant amount of risk, but also a significant amount of gain when trades would work. So you have to expand your stop, but also expand your targets to keep your R factor the same. I go for an R factor of 2 or better. So these are the numbers, the rotational numbers for the ES, NQ, RTY, YM, CL. The NQ is at 42.5 points in terms of what would be a normal rotation, which is insane that this thing is moving 42.5 points in a back and forth rotation. But a quick look at the charts on a 1 minute, looking at top swings and swing tops and bottoms and subtracting those from each other will show you that that's the case for a 1 minute bar chart. So pay attention to that. This week, today, the calendar is pretty light. We have 10 a.m. We did have some numbers this morning. We had personal income, personal spending, durable goods. Durable goods orders were strong. That's quite bullish. The consensus was 1.6%. We got 2.5. Personal spending month on month came in at 0.6, in line with consensus, and personal income came in at 0.4, in line with consensus. New home sales is expected to report 0.77 million. And then this evening, we do get Michigan's consumer sentiment at 10, but this is the final number, generally not a mover. And then this evening, for those of you who trade through the Asian session, pay attention to the inflation rate coming out of Japan. The forecast is 0.4%. And tomorrow is a holiday. Tomorrow, there's no trading in the European and US markets. Japan releases a housing starts number. And then what happens next week is we have a whole bunch of numbers, but none of them are high tier, really. So looking through next week, there's just a bunch of stuff, routine stuff like U.S. wholesale inventories, pending home sales, retail inventories for vehicles, the crude oil inventories, API oil stock change. We have jobless claims, initial claims. Chicago PMI next week, although that hasn't been a mover lately. The only high tier number next week that we have is the MBS manufacturing PMI out of China. So a pretty light week next week, but I'm expecting it to have a lot of movement next week. I expect a lot of volatility to continue through next week. So I will be here and I'll be trading. So let's step back and look at the S&P. The S&P is in a multi-distribution auction right now. It's got two distinct distributions. The overnight inventory is 98% long. The volume is quite light for this time of day, 116,000. Given the amount of volatility, would expect it somewhere around 200. It's at 116,000 with 19.25 points of range. The point of control at 46.90, and we're currently trading at 46.99 even, up 13 points or 28 basis points. This is where we are overall. I want to take a quick, so here's what we've got. So I'm going to move right into looking at the composite and just seeing what the big picture is. Remember, each one of these boxes represents a week. So each one of these boxes, gray or dark gray boxes, represents a week of trading. Each candlestick represents a day of RTH trading, RTH being defined as 9:30 to 4 p.m. U.S. Eastern Time. Basically, the RTH session for the futures in the indices is now the same as the stock session or the equity session or the cash session. So each one of these boxes represents a week. Each change in color, every time there's a change in color, it's a new month. So now we can compare day to day, week to week, and month to month on this chart. And what we see on the monthly is that we are on an inside, we've been in an inside month overall. We did not poke any lower than we were the prior month. We actually let's see. There's something going on here. Yeah, so the monthly is on is one time framing down. The weekly is one time framing down starting this week with this gap lower on Monday is one time framing down. Really, the position on the monthly, the weekly, and the daily are neutral. The daily established one time framing up yesterday, but really we're in this neutral zone and we've pushed back into, let's expand this a little bit because the point of control isn't correct here. Okay, yeah. 46.83 was the target yesterday, and it got through it, went to 46.8750. But overall, we're in this really, really consolidated area in the S&P. If we look at the bigger picture, let's switch this to automatic. If you look at the bigger picture, let me just kill every. There we go. If you look at the bigger picture, this is basically the run here from January of 2020. January 2020 being right here. Really, this is January 2020 right here. This is the pandemic drop, and this has been the run. And you could see that we're not relieving that high very well. We pull back just a bit. It looks like we are done. It looks like it's bad news, be it Omicron, be it whatever, inflation. But we are hugging that all-time high. We're likely to continue to do so. Equities have a mind of their own, and money just continues to be dumped in there. But overall, we're not letting go of these highs, and we're in this big consolidation zone. We're back into this big consolidation zone and holding steady. Yesterday's session ended very strong. So what we had yesterday is almost a trend day with the point of control not shifting to the high of day, but we had a lot of volume go off at the high with settlement of 46.86 right against that 46.8350. So this is a market that has dipped below and has quickly come back to the most important magnet in the area. Again, that is 46.8350. 46.8350. Keep that number in mind. That is the most accepted price in this zone. So this is a market that has tested below. So you can see here, this is a full session chart. This is a market that has dipped and tested below and keeps coming back to this same area again and again and again. So the top here is vulnerable. We keep coming to the top and pulling off. We shifted, we moved the high overnight to 47.43, but in a day session we sold off, so we didn't actually push the all-time high in the RTH session. We did in the overnight session right in here last week sometime. But overall, it's not moving away from there. So it's a market that is hesitant and is waiting for news in order to be able to make that move. So that's where we stand this morning. I'm not, it's likely to be a two-way type of market. It's likely to continue to be volatile, as I said. Here's a look at the my overview chart on Edge Pro X. You recall last week we ended up tagging the monthly VWAP. We ended up popping higher. We made that new all-time high in the full session, and then we pushed right back through the monthly VWAP right below that 46.15 area, and then we came back to it, consolidated. We popped through the 46.1550, the monthly VWAP, and then we pulled back to 46.1550 again before launching forward to 46.50, which is the next key obstacle on the way up. And here we are back again near those highs. So we're back. You can see there's a lot of consolidation and big zippers in this area. A lot of zip action, a lot of balance there, and we are dead in the middle of it. So I'm expecting this morning, although we are higher, I'm expecting this morning to be relatively choppy, because if you look at the big picture, as we see on this 4-hour all sessions chart, you can see that we're back in this chop, chop, chop zone, and that's likely to again instigate two-way action, therefore chop for us. The Dow, same kind of picture. The Dow showing a little better strength than the S&P. The Nasdaq continues to be in this funky downtrend for the month. It is holding steady up here now, but it's starting to approach that upper line, downtrend line in this channel. The Nasdaq is weakest of the bunch right now. In terms of the Russell, again, the small caps are weakest. They've been in this downward skew for some time, but it looks like it is starting to break. You could see it popping through this upper line in this downtrend channel. The small caps are going to react most aggressively to anything that's disruptive, like a pandemic, or any news that is inflation related. Essentially, smaller companies, which are represented by the Russell, the small cap 2000, smaller companies are going to feel it more quickly in their bottom line, in their earnings, productivity, and so on, when there's a disruption, much more so the mega caps or blue chips. This is why the Russell generally will lead on news. If you haven't noticed that, you might pay attention to the fact that the Russell just opens stronger on good news, opens much weaker on bad news. It's always kind of swinging. It has a higher beta to the blue chips and kind of does its own thing. Gold has bounced off of its monthly here since the inflation, since the FOMC. It's held a bit of a bid, but really overall, what has it done? It hasn't really gone anywhere. It's trading sideways. Silver, same kind of story. The treasuries have been incredibly stubborn. They've been stuck and whipping around their VWAP all month. We're approaching the end of the month. Look at the 10-year here, just really not getting off of its VWAP all month, completely consolidating despite news of more aggressive stimulus drawbacks, more aggressive rate adjustments by the FOMC and so on. Those of you who were at the fireside chat yesterday probably heard Jeff Snyder, who is just a macro guru, talk about the fact that the Treasury market is really betting against the Fed in terms of inflation. They're almost pricing in deflation, which was kind of, I didn't have a clue. I listened to several macro podcasts, and I didn't hear that theme come through so clearly. So overall, the Treasury market is really not playing along with the narrative on the news media. Looking at crude oil, and I know this is taking a while, but it's my first day back here, and I'm catching up. Looking at crude oil, same thing. Crude has got a lot of overhead. I've been watching for crude to get back to 75, really 74, 75 to 75 was the expected rotation up once we hit 63. It hit 63, which was projected. It hit it pretty well, and it bounced right off. And I was looking for 74, 75 to 75 even test, and it's had a hard time doing that. Crude currently trading at 72.83. Nat gas staying below VWAP in a downward sloping VWAP. Nat gas looks weak, and it looks like a bear flag here that's likely to fall off. Let's shift our attention to what's expected for today so I can let you guys run. Let's see. One second, let me make an adjustment here. Sorry, I've got some numbers that are jumbled on top of each other. Okay, here we go. So, what are we expecting for today? So I'm just going to look at one Vola Sigma of range. So this much range here. This morning, expecting a relatively choppy open. As I said, not really going to be aggressive. I'm looking for an open auction that reverts back. I'm expecting a tag of the 46.86 area, the prior settlement, and close. We could see the S&P drop all the way down to 46.78 or so. We are really in this high volume node, this MC point of control at 83.50, expecting responsive action to pull back to at least 78 or so, and then it might take a bounce, consolidate in the middle here before it starts its upward drift. So I'm expecting the overnight low to be taken. The overnight low is around 84.75 or so for a test to 83.50. 83.50 is expected, and potentially down to 78 on a pullback before it starts finding a base and pushing higher. Why? Because yesterday was a straight run up from the overnight high of about 46.46 all the way up. It's been a straight run up, so I'm looking for it to regain this high volume node from yesterday before it finds a base. So I'm expecting it to come back to the 78 area. That's scenario one. Scenario two, on a gap up, is the traditional open, consolidate, small attempt lower, strong push through. I expect it to push through this 47.07 area, and then start looking for the next key area up, which is 47.23. That was last week's RTH high, 47.23, and that sets up a potential push to the all-time high figure of 47.3375. So that would be the bullish scenario, a continuation of yesterday, just buying into the holidays. Those are the two key scenarios today. The key number above being the all-time high in RTH, which is 47.3375, and the all-time high in Globex is right up here at 47.43 1/4. Okay, that's a lot to cover. We have 5 minutes to the open. Good luck, everyone, and I'll catch you on Monday. Tomorrow is a holiday. Take care.